The Bank of Canada just held rates at 2.25%, and if you think that means nothing changed, you're missing the real story. Right now, the economy is like a machine with 3 gears that are completely jammed. Inflation is finally under control at 1.8%, but your job market is weakening with unemployment climbing to 6.7%. And then there's global uncertainty. The Middle East conflict is driving up oil and gas prices higher. US tariffs are hitting Canadian goods. I'm going to show you exactly how these 3 gears lock together to explain why a pause is actually the better move they had left. Once you see this, you'll understand why your next financial decision depends on it. Hi, Kane again. I graduated from theater school as a struggling artist. 20 years later, I was able to purchase properties throughout Ontario. Be sure to watch my biography video to see my challenges. Moreover, review my references in the description. If there are any discrepancies, please let me know. Without further ado, let's get started. Think of the economy like a machine with 3 gears. Each one spins separately, but they're all connected. One gear is inflation, another is jobs, the third is global risk. Right now, they're all turning at different speeds, and that's why the bank is stuck. Let's look at the first gear, inflation. On paper, it looks great. CPI is at 1.8%, which is actually below the bank's 2% target. Core inflation is near 2%. You think the bank can finally relax and maybe cut rates soon. But here's the problem. The low number isn't because people stopped spending. It's because supplies are tight. Energy prices jumped around. One Middle East flare-up, one refinery problem, and suddenly 1.8% can potentially jump to 2.5 overnight. The bank knows this. They can't celebrate yet because one shock could undo everything. That's the uncomfortable trade-off they're facing. The second gear is the labor market, and it's grinding hard. Canada's GDP actually contracted 0.6% in the fourth quarter of 2025. Unemployment just hit 6.7%. The number keeps climbing. People are working fewer hours. Companies stopped hiring as much. Population growth isn't filling the job gaps like they used to. When the gear weakens, the bank normally cuts rates to get people spending and hiring again. But they can't do that now. If they cut rates early, spending goes up, energy prices spike, inflation jumps back, and they're stuck. The third gear is global uncertainty. Middle East conflict is driving energy prices higher. US tariffs have already cut Canadian exports by roughly 5%. Supply chains are still fragile. Transportation bottlenecks in the Strait of Hormuz are adding to commodity supply risks. The gear is unpredictable. It can break the whole machine. The bank is trapped. They can't raise rates because the economy is slowing and inflation is controlled. They can't cut rates because one energy shock or tariff move could reignite inflation fast. The only choice left is to hold and watch what happens next. The pause hits different people in completely different ways depending on your situation. If you got a variable rate mortgage, you got a small win. Your payment doesn't go up, but don't mix up relief with safety. The bank is holding because they're uncertain, not because rates are done moving. Energy prices could spike tomorrow and they might cut. Or inflation could jump and they might hike. You're in a holding pattern, not a trend. If you locked in a fixed rate recently, you're fine short term. But here's the thing, fixed rates aren't set by the bank's overnight rate directly. They're priced on what markets think will happen next. Based on Government of Canada bond yields, markets are already betting on a rate hike by year end because persistent inflation risks from oil and tariffs. Also, if you're shopping for a fixed rate mortgage right now, you might actually lock in better rates for a few months. Rushing in today could cost you. For investors, this is where it gets interesting. A pause tells you volatility is coming. The bank isn't confident. That means mortgage rates could move up or down depending on energy, tariffs, or jobs. The bank is in wait-and-see mode, ready to move either direction. Investors who lock in financing now before anything moves has an edge over people waiting for perfect clarity. Right now, positioning matters more than timing. For everyday Canadians, the pause is actually bad news, dressed up as stability. Your job market is softening. Unemployment is rising, but your rent, groceries, and utilities aren't dropping. The bank can't cut rates fast enough to help without risking inflation. You're stuck, paying high costs with a weaker job market. This isn't a safe zone. It's a waiting room, where you're still sitting on edge, and what happens next depends entirely on the moves you make today. The bank just told you the economy is fragile and policy is patient but vigilant. Your next move matters more than ever. If you're deciding whether to invest, refinance, or wait, you need a strategy built for this environment. That means stress testing your plan against 3 scenarios: a rate cut if the economy weakens further, a continued pause, which is most likely, or a surprise hike if energy stocks reignite inflation. Know what you do in each one. Position yourself properly. Before your next financial move, look for the jammed gears in your own portfolio. Evaluate risk tolerance based on those 3 scenarios, because the Bank of Canada just signaled that all 3 are on the table. If you've enjoyed this material, be sure to watch my next video on how the rich protects their families from lawsuits.